Let me tell you about two men. The first man spent 35 years working as a janitor and a gas station attendant in a small Vermont town. He drove a used car, wore second-hand clothes, and was so frugal that his neighbors assumed he was struggling just to get by. When he died in 2014, everyone expected a modest estate, maybe a few $1,000s, enough to cover a simple funeral. What they found instead was $8 million. The second man was a Harvard-educated Wall Street trader who by his mid-30s was pulling in $750,000 a year. He had a penthouse in Manhattan, a house in the Hamptons, and a reputation as one of the sharpest financial minds in his firm. By 50, he was filing for bankruptcy. Same country, same economy, completely opposite outcomes. And here is the part that should stop you cold. The janitor had no financial education. The trader had every advantage the system could offer. So what actually separates the person who builds lasting wealth from the person who earns a fortune and loses it? It is not intelligence. It is not access. It is not even income. It is something far more uncomfortable to admit. It is behavior. It is the invisible psychological forces that govern every single financial decision you make, most of them without you even realizing it. Over the next 30 minutes, we are going to go somewhere. Most financial content refuses to go. We are not talking about which stocks to buy or which index funds to choose. We are going to dig into the human mind, your mind, and examine the deeply wired instincts, emotional patterns, and cognitive traps that are almost certainly costing you money right now. By the end of this, you will not just understand wealth differently. You will understand yourself differently. And that shift, that single shift in self-awareness, is worth more than any stock tip anyone could ever give you. Let's start with something that sounds almost insultingly simple. But I promise you, most people never truly internalize it. Everything worth having comes with a price. I know, you've heard that before. But stay with me, because the price I'm talking about is not the price most people think about when it comes to investing. When people imagine the cost of building wealth through the stock market, they think about money. They think about the dollars they are setting aside, the opportunity cost of not spending that money on something enjoyable right now. That is the obvious price. But there is a hidden price, a psychological price, that almost nobody prepares for. And it is this hidden price that causes intelligent, disciplined, well-intentioned people to blow up their own portfolios at exactly the wrong moment. That price is volatility, and more specifically, the emotional experience of volatility. Here is what I mean. Imagine you decide in the early 1990s that you believe in a small video rental company that has just started mailing DVDs to people's homes. You invest a meaningful chunk of your savings into Netflix. You are visionary. You are early. Fast forward to today, and that decision looks like one of the greatest investments in modern financial history. But let me tell you what that journey actually felt like from the inside. In 2011, Netflix made a series of strategic decisions that its customers absolutely hated. They raised prices. They attempted to split the company into two separate services. The public backlash was immediate and ferocious. Subscribers cancelled by the hundreds of thousands. The stock, which had been on a meteoric rise, collapsed, not dipped, collapsed. It lost roughly 80% of its value from peak to trough. If you had put $100,000 into Netflix before that crash, you were now looking at around $20,000. Now I want you to sit in that moment, really sit in it. You have watched $80,000 of your money evaporate. Your spouse is asking questions. Maybe you have kids whose college fund was in that position. Your friends are watching you, some of them quietly relieved that they did not follow your advice to buy in. Every financial news headline is screaming about Netflix's death spiral. Every instinct in your body is telling you to sell what is left. Cut your losses and never think about this again. What do? If you sold, you were not stupid. You were human. You were responding exactly the way millions of years of evolution designed you to respond to a threat. But if you sold, you also missed one of the most spectacular recoveries in stock market history. Netflix went on to become one of the defining companies of the 21st century, and the investors who held through that devastation were rewarded with returns that most people only dream about. Here is the critical insight. The volatility was not a bug. It was the price of admission. It was the fee that the market charges for extraordinary long-term returns. And the people who understood that, who mentally reframed volatility from danger signal to the cost I agreed to pay when I bought this ticket, those are the people who came out the other side wealthy. Now let me extend this beyond individual stocks, because I know some of you are thinking this only applies to people making concentrated bets on single companies. Even the most diversified, conservative approach, even just buying a simple index fund tracking the 500 largest American companies, comes with this price. If you had bought that kind of fund in 1980 and held it for the next 4 decades, you would have experienced roughly 13 separate years where your portfolio was down more than 20% from its peak. And there were stretches, brutal, stomach-churning stretches, where you watched half your money disappear on paper. The people who got rich were not the ones who avoided those downturns. You cannot avoid them. They are part of the deal. The people who got rich were the ones who had made peace ahead of time with the price they were going to pay. They had looked themselves honestly in the mirror and said, "I understand that this journey will hurt. I understand there will be moments where everything inside me screams to get out. And I am committing right now, while I feel rational and calm, to staying the course when that moment comes." That is not a financial decision. That is a psychological one, and it is the most important financial decision you will ever make. Now, I want to talk about something that I believe is the single most underestimated destroyer of financial well-being in modern life. It is not a bad investment. It is not a market crash. It is envy, and more specifically, the particular form of envy that is uniquely amplified by the world we live in today. Let me paint a picture that might feel uncomfortably familiar. You have worked hard. You have been disciplined. By most reasonable measures, you are doing well financially. You have savings. Maybe you own a home. You take a vacation once a year. Life is genuinely good. And then you open Instagram, or you attend a colleague's birthday dinner, or you read an article about someone your age who just sold their startup for $40 million. And suddenly, almost instantaneously, everything you have built feels inadequate. The satisfaction you felt 5 minutes ago has evaporated, replaced by this gnawing, hollow feeling that you are somehow behind, that you are losing a race you did not even know you were running. This is one of the most financially dangerous mental states a person can be in, and here is why. When envy activates, your relationship with risk changes in ways you do not consciously register. You start to reach. You start making investment decisions that are not calibrated to your actual situation, your actual goals, your actual risk tolerance, but instead calibrated to close a gap between where you are and where you perceive someone else to be. And those decisions almost universally end badly. Let me show you how the comparison trap works at every level of wealth, because people often assume that this is a problem that disappears once you have made it. It does not. Think about someone earning $500,000 a year. By any objective measure, this person is extraordinarily successful. They are in roughly the top 1% of income earners in the United States. They live well. They have options that most people will never have. But put them in a neighborhood where their peers are earning $5 million a year, and something shifts. The private school their neighbors' kids attend suddenly seems like the baseline. The family vacation to Europe feels modest compared to the chartered yacht in the Mediterranean. The perfectly nice car in the driveway somehow looks like an admission of inadequacy. Now take the person earning $5 million a year and put them in rooms with people worth 200 million, 500 million, $1 billion. Suddenly, the goalposts have moved again. And at that level, the dangerous behaviors that comparison drives are not buying a slightly nicer car. They are leveraging investment portfolios to chase returns that match what the hedge fund manager across the table is bragging about. They are taking concentrated risks that they would never take if they were thinking clearly about their own financial position. Throughout financial history, some of the most spectacular collapses, people who had genuine, substantial wealth and destroyed it entirely, were not caused by ignorance or bad luck. They were caused by this, the refusal to accept that enough was enough. The inability to declare victory and stop playing a game that no longer needed to be played. And I want to spend a moment here on something that rarely gets discussed in financial content, because I think it is genuinely important. The comparison trap is not just psychologically damaging, it is philosophically incoherent. Here is what I mean. When you feel the sting of envy because someone else has more than you are implicitly measuring your life using someone else's ruler. You are outsourcing the definition of enough to external circumstances you did not choose and cannot control. And when you outsource that definition, you guarantee that you will never feel it, because there will always be someone with more. The scale of wealth at the very top is so incomprehensibly large that even people with hundreds of millions of dollars are poor by comparison to those with billions. The game, if you play it on those terms, literally cannot be won. So, what is the alternative? The alternative is to do something that sounds simple but requires genuine psychological work. Define enough for yourself on your own terms before you get there. Not a vague, aspirational, someday I'll have enough, but a specific, deliberate accounting of what your life actually requires to feel genuinely satisfying. What experiences matter to you? What freedoms are you actually seeking? What would a life look like where you could honestly say without qualification that you have what you need? The people who build lasting wealth and actually enjoy it, they have answered that question before they needed the answer. They know when to stop, and knowing when to stop is one of the rarest and most valuable financial skills that exists. I want to shift gears now and invite you into a perspective that has the potential to completely change how you think about financial mistakes, both your own and other people's. It is a perspective that requires intellectual humility, and it pays dividends in ways that are hard to predict but genuinely transformative. Here is the core idea. Almost every financial decision that looks irrational from the outside makes perfect sense when you understand the full context of the person making it. We are all walking around with an invisible set of lenses shaped by our childhood, our parents' relationship with money, the economic conditions we grew up in, the financial wins and losses that left the deepest marks on us, and the cultural context that surrounded all of it. These lenses are so built into how we see the world that we do not even experience them as lenses. We just experience them as reality, as how things obviously are. And when someone else's behavior looks crazy to us, when we see financial decisions that seem obviously wrong, obviously reckless, obviously irrational, what we are usually seeing is not stupidity. We are seeing a different set of lenses, colliding with our own. Let me give you an example that I find genuinely illuminating. There is a phenomenon in behavioral economics that researchers have studied extensively. The tendency of lower-income households to spend disproportionately on lottery tickets. On a pure expected value basis, this looks like one of the worst financial decisions a person can make. The odds are terrible. The money spent could compound over decades into something meaningful. If you have a financial education, this behavior is almost incomprehensibly counterproductive. But here is what you are missing when you look at it from that angle. For someone living paycheck to paycheck, with no realistic path to significant wealth accumulation, no access to the kinds of investment opportunities and career trajectories that lead to financial security, the lottery is not a bad investment. It is the only plausible mechanism they can envision for a fundamentally different life. The expected value of the ticket is not just the mathematical payout probability. It includes the hours of imagination, of possibility, of genuine hope that the ticket purchases. That is a real thing. That has real value to real human beings. Now, I am not arguing that lottery tickets are a good financial strategy. They are not. But understanding why people make this choice, rather than simply judging it, opens up something important. It forces you to confront the degree to which your own financial decisions are shaped by context that feels universal to you, but is actually deeply specific to your particular experience. Think about how this plays out in investing. Consider the differences between someone who grew up during the Great Depression and someone who entered the workforce in the 1990s bull market. The Depression-era investor saw financial institutions fail, savings evaporate, and an entire generation's wealth destroyed almost overnight. The psychological imprint of that experience, even decades later, translates into a powerful, almost visceral distrust of the stock market and banks. Holding cash under the mattress does not look irrational. Through that lens, it looks prudent. It looks like hard-won wisdom. The 1990s investor, on the other hand, watched markets climb almost continuously through their formative years. Risk tolerance for them feels almost natural, because the market delivered for as long as their memory extends. These two investors will make different decisions with the same information. Not because one is smarter, but because they are drawing on different lived realities. Here is how this applies practically to you and to me. The first application is self-awareness. When you make a financial decision that, in retrospect, was driven by emotion, by fear or greed, or the burning need to prove something, the path forward is not self-flagellation. It is honest investigation. Where did that impulse come from? What were the underlying psychological drivers? Because until you understand the source of your own financial instincts, you cannot evaluate which of them are serving you and which are sabotaging you. The second application is about the danger of copying. One of the most common mistakes in investing is trying to replicate someone else's portfolio or strategy without accounting for the fact that their strategy is calibrated to their situation, their timeline, their risk tolerance, their goals, not yours. A billionaire's investment approach is optimized in large part for wealth preservation. If you are 32 years old and building wealth from scratch, the priority is growth. Copying the billionaire's defensive strategy might feel safe. It might cost you the returns that would make the biggest difference in your life. Understanding that different contexts produce different rational behaviors does not mean that all financial decisions are equally valid. But it does mean that the path to better decisions runs through genuine self-understanding, not through mimicry, not through judgment of others, but through the honest and sometimes uncomfortable work of knowing your own financial psychology. Let's talk about prediction. Specifically, let's talk about why financial prediction is largely a performance, a very convincing, very entertaining, very lucrative performance, and what you should actually be doing instead of trying to forecast the future. Every financial media ecosystem is built on a fundamental promise that with the right analysis, the right data, the right expert, you can get ahead of what's coming. Watch enough CNBC, read enough analyst reports, follow enough macroeconomists on social media, and you will be able to position your portfolio to avoid the crashes and capitalize on the rallies. The industry that has grown up around this promise is enormous. It is also, by the evidence of decades of research, largely a fiction. Here is the uncomfortable truth. The events that cause the most significant disruptions to financial markets, the crashes that wipe out fortunes, the crises that reshape economies, are almost uniformly events that were not on anyone's radar before they happened. Not on the radar of the most sophisticated hedge funds. Not on the radar of central bank economists with entire departments devoted to forecasting. Not on the radar of the Nobel laureates who study these markets for decades. Think about the sequence of major disruptions over the past 100 years. The Great Depression, World War II, the oil shocks of the 1970s, the savings and loan crisis, the Asian financial crisis, the dot-com collapse, September 11th, the 2008 financial crisis, the COVID-19 pandemic. Every single one of these events in retrospect seems like something people should have seen coming. And in retrospect, you can always find the handful of analysts who raised early warnings. But in real time, when the decisions actually had to be made, these events were not on the mainstream radar. They could not be prepared for by trying to predict them. There is a concept called black swan events that captures this precisely. A black swan is an event with three characteristics. First, it is genuinely outside the normal range of expectations. Nothing that came before it would reasonably lead you to anticipate it. Second, its impact is massive and far-reaching. And third, after it happens, humans immediately begin constructing narratives about why it was actually predictable all along. We are storytelling animals, and we are extraordinarily good at creating plausible causal chains after the fact that make the event seem inevitable. This after-the-fact predictability is an illusion, and it is a dangerous one, because it reinforces our belief that with enough cleverness we can see these things coming next time. We cannot. That is the nature of the thing. Now, there is a practical financial implication here that is perhaps the most important point in this entire video. Every hour you spend trying to predict macro events, trying to position your portfolio around which way interest rates will move, or whether inflation is about to spike, or which geopolitical tension is going to escalate into a market-moving crisis, that is time spent on a fundamentally unreliable strategy. And more dangerously, it is time spent creating the illusion of control that might actually lead you to take concentrated risks based on forecasts that are largely guesswork dressed up in sophisticated language. Here is the data point that should reorient how you think about this. If you invested in a broad market index fund 2 decades ago, your long-term returns were substantial. But research has shown that if you missed just the best few days in the market over that period, just the absolute best handful of days out of roughly 5,000 trading days, your returns would be cut dramatically, less than half of what you would have earned by simply staying in. The best days in the market are often impossible to predict. They frequently happen right in the middle of, or immediately after, the most terrifying and chaotic market environments. The investors who were clever enough to get out near the bottom, to wait for clarity before getting back in, they typically missed those best days. They got out in the panic and got back in after the recovery was already well underway. So, if you cannot predict the catastrophes and you cannot predict the recoveries, what can you actually do? You can prepare. There is a profound and important difference between prediction and preparation. Prediction says, I believe this specific bad thing is coming, so I will position myself to avoid it. Preparation says, I do not know what bad thing is coming, but I know something bad will come eventually, so I will build a life and a portfolio that can survive a range of possible outcomes. Preparation looks like maintaining liquidity so that a down market is not a forced selling situation. It looks like having an honest conversation with yourself about your true risk tolerance, not the theoretical risk tolerance you claim on paper, but the visceral, gut-level tolerance you actually have when you are watching your net worth drop in real time. It looks like constructing a portfolio that you can genuinely hold through the worst scenarios you can imagine, because the worst scenario that actually arrives might be worse than anything you have imagined. The most resilient investors in history were not the best predictors. They were the best preparers. And that is a skill you can actually develop. There is one final piece of the psychological puzzle I want to leave you with, and I think in some ways it is the most counterintuitive of everything we have discussed today. It is about pessimism, specifically why pessimism feels so much more intellectually credible than optimism, and what that bias costs you financially over a lifetime. Here is an experiment. Imagine I sit you down and give you 2 presentations, back to back. The first presentation makes a detailed, data-rich case for why a major market crash is coming in the next 18 months. It talks about debt levels, geopolitical instability, valuation multiples at historic highs, the end of an economic cycle. The second presentation makes an equally detailed, equally data-rich case for why the next decade is likely to see continued growth in human prosperity, driven by technological innovation, expanding access to education and markets in the developing world, and the compounding benefits of decades of scientific progress. Which presenter do you trust more? Which presentation do you find more compelling? If you are like most people, the pessimist got you. They felt more credible, more serious, more like someone who really understands how the world works, as opposed to the optimist, who seems slightly naive, slightly promotional, slightly like they might be trying to sell you something. There are deeply rooted reasons why this is the case. Evolutionarily, we are wired to attend to threats more urgently than opportunities. An ancestor who underestimated a danger died. An ancestor who underestimated an opportunity merely missed a meal. The asymmetry of consequences meant that our brains evolved to give danger signals a premium, to take them seriously, to remember them vividly, to respond to them quickly. In the savannah, this was survival. In the financial markets, this wiring costs you money. There is also a structural reason why pessimistic narratives feel more compelling in the media landscape. Progress is slow. It accumulates gradually, invisibly, over years and decades. The fact that global child mortality has plummeted over the past half-century, that more people have been lifted out of extreme poverty in the last 30 years than in the previous 300, that diseases which once devastated populations have been eliminated or dramatically curtailed, none of this generates a headline. None of this produces the sharp, compelling, immediate story that captures attention. Catastrophe, on the other hand, happens fast. It is vivid. It is concrete. It generates tremendous narrative energy. A crash happens in a day. A recovery takes years. This means that your information environment is structurally biased toward the negative. Not because the world is getting worse by many of the most important measures. It is getting better, but because bad news is better. Content. And when your information environment is biased toward the negative, your worldview naturally skews pessimistic, and your financial decisions follow. The practical consequence of this bias is that investors, on average, hold too much cash during bull markets because they are perpetually waiting for the crash that the pessimists keep predicting. They make defensive moves at the wrong times. They are seduced by sophisticated bearish arguments into sitting on the sidelines while markets compound. I am not arguing for naive optimism. The market does crash. Bad things do happen. A balanced, realistic worldview has to hold both the genuine risks and the genuine trajectory of human progress simultaneously. But if you notice that you are consistently more moved by the bearish case than the bullish one, if the pessimist in the room always sounds smarter to you, that is worth examining. That is a bias that is costing you something. So let me bring this all together, because I want to leave you with something you can actually use. Wealth, at its most fundamental level, is a behavioral challenge before it is a mathematical one. The math of compounding is simple. The behavior required to let compounding work, the patience, the self-awareness, the psychological stability, that is the hard part. That is the part most financial content never addresses. Pay the price of volatility consciously rather than being blindsided by it. Define what enough means on your own terms before you need the definition. Understand your own financial psychology deeply enough to know which of your instincts are serving you and which are sabotaging you. Prepare for a future you cannot predict, rather than trying to predict it. And when the pessimist sounds compelling, pause long enough to ask yourself whether your evolutionary wiring is doing your thinking for you. The janitor who died with $8 million was not a financial genius. He was someone who understood intuitively, or deliberately, these basic truths about human behavior and money. He saved consistently, he stayed the course, he lived below his means. He did not try to outrun his situation. He just let time do what time does when you give it the right ingredients. That story is not as exciting as a hot stock tip, but it is the one that actually works, and now you know why.